If we were ranking my losses, I think that every time I've had like bad losses, like proper bad ones, like the one that I had on Bank of America where I did a video about. 95% of my losses pretty much always come from selling calls, which can actually raise the question, why do I bother selling calls? Is there actually value selling calls when, in the end, I'm always getting crushed on the call side? And as for example, I showed with Bank of America, I mean, like those are proper bad losses. We're talking about 5x, 6x. I mean, is it even worth still selling calls? Even though it's a real pain. Like, I gotta say, I mean, honestly, most of my biggest losses that I had during 2021, like on FCX, Bank of America, they always come from calls. That's, a fact. However, I think that there is value in selling calls, and here's the reason why. On the paper, I know that when you sell calls, the loss is potentially unlimited, meaning that if you sell a call when the stock is at like $100, well, there is no reason, or at least there is nothing preventing the stock from going from $100 to, let's say, $500. And then, your loss is theoretically unlimited compared to when you're selling puts, the stock can only go down to $0 basically. And I get that argument. Honestly, I fully get it. I'm fully aware that, when you're selling calls or naked calls, you potentially have an unlimited loss. I know that. However, in my opinion, there's still value in selling calls, and just for a matter of not only being long to the market and also having a short exposure, meaning that if the stock actually comes crashing, or if the stock market in general comes to crash, well, at least you're not just exposed on the long side. And I think that's a huge point in the favor of selling calls. Because the problem is, if you're only selling puts, which is not necessarily a problem, by the way. I mean, if you just want to sell puts, feel free to do it. However, when there's going to be a crash, all your positions, like every one of them, will be in the red, like proper red. And if you have invested, let's say, just 25% of your account, that's like 25%, that's all your positions that are going to go deeply in a loss. And that can be extremely stressful and painful also. That's why, personally, I like to sell calls at least. And I'm going to show my portfolio in a second so you can see what I mean by this, because I feel that this is still important to have some short exposure, even though I know that it's a pain. Like, I know that most often my calls tend to be more in the money because the market tends to rise, so they are obviously going to get in a loss more often than my puts. However, I still feel it's worth it. I can't help but thinking that it's still worth having some short exposure. And let me show you my portfolio so you can see what I mean. So this is my portfolio, and if we just do a breakdown of each and every single positions that I have, we can see that I, for example, sold a call on Bank of America, the 41 strike, and right now the stock is at $46.72. So that was actually, I made a video about this trade because it went so badly against me. And this is exactly what I mean. I know that, is going to be a pain. Like, for example, my FCX trade is also in the money. I sold a call credit spread on FCX, and I sold a 38 strike, and now the stock is at $38 per share. So it's basically in the money about 5 cents. And then after that, I sold basically 2 strangles on GDX and Foot Locker, and then I basically sold puts on, for example, LVS, KR, JPS, and EWZ. Sometimes I also sold some put credit spread, for example, as you can see on Gap. And I'm pretty sure that my performance so far, so you can see that this year my P&L is of $5,159. I'm pretty sure that, if I had only sold puts like every single time and never sold a call, I'm pretty sure that my performance, actually my P&L, would probably be higher than this. And I just don't feel comfortable only selling puts, because the thing is, let's imagine that instead of having sold some calls, like each and every single stock that you see in my portfolio right now, let's say that I only have sold puts. When a crash is going to come, how badly my portfolio is going to be affected. And regardless if it's a put credit spread or not, like, because even if it's a put credit spread, you're going to want to roll it, I guess, and so you're going to have to take a loss anyway, and you're going to need to have much more buying power required in your account that is free so as to sustain the losses that you have on all the puts that will be in the red. And at least during a crash, if you have sold some calls, you won't be in massive losses on those positions at least. What if you invest 15% in long positions and 15% in short positions? And at least if you're in a crash, that's only half of your portfolio that is invested that is going to be in trouble. And the other half is basically going to be in profit instantly, or if not, it's not going to go in losses as much as the put side because the market is going to go down. So by definition, your calls will be very far out the money and they'll pretty much be worth nothing anymore. And that very simple logic, I think it still has value. I think it's still worth doing it, even though on the short term, yes, I have like bad losses sometimes, like on Bank of America, which is, by the way, the worst loss that I had in 2021. So it doesn't happen every day, but it's true that when I sell calls, they tend to get more often in the money. They tend to be more annoying, honestly, because those are trades that are quite often going into losses. But by just rolling them to the next expiration, by just keeping on rolling them, then, at some point they just get back in profit. And I know that I'm pretty much making my life more complicated by selling calls, because I could just sell puts and, just make more money, because the stock market tends to rise anyway, like just naturally. So I would just make more money by only selling puts. But I think that's a very, very dangerous line that we're playing with when we're selling puts. And as much as when you sell calls, you have unlimited loss, or at least on the paper, unlimited loss, there's only like stocks like Tesla or, very bad, poor quality stocks that are going to rise by 200%. Like, for example, Ride. I mean, otherwise, when you're trading like normal companies that are like healthy, that have a normal balance sheet, and, they are not like crazy, insane stocks that are just meme stocks, well, they're not going to rise by the 100% overnight. And I know that can be quite controversial, and I know that some people will pretty much be like, it hasn't happened to you yet, but it's probably going to happen at some point. And, that's fair to say this. But if you're afraid of selling naked calls, then just sell call crit spread. But at least have some short exposure. At least, for God's sake, like have at least some exposure on the short side. So if a crash happens tomorrow, then you're not just exposed on the long side. And I know that it's very, very tempting to just sell puts because you just make more money. But you need to think in terms of worst case scenario. And honestly, always thinking about the worst case scenario and what would I do during that time has saved me from a ton of losses. If I had a tip to give like to someone who's just starting with options, thinking about the worst case scenario is always a good thing. It forces you to think about, what am I going to do in that situation if that happens? Even if it's extremely unlikely that it happens, what if that happens? And what will I do when that happens? That's honestly the most important thing that I could tell someone who's just starting with options. And if you think that, for example, selling calls is not worth it, at least consider the following. When you're going to sell puts, it's going to require you to have, for example, let's say $1,000 in buying power in your account that is free, so you can sell that put option. That will be the margin, that will be the collateral that will be held by the broker. You know that collateral, except if you sell a put crit spread, if you sell a naked option, it will expand, or it will like become smaller over time depending on where the stock is going. And it's not unlikely, if a stock goes against you, to see the buying power required like triple. It's not like uncommon to see that instead of needing like, for example, $1,000 in buying power in your account, now you need $3,000 because now the stock went against you and your option that you sold is now in the money. And of course, you don't have this problem if you're buying options, but here I'm really talking if we're selling options. So you really need to consider this when you are, for example, selling options, because if, let's say, you are only selling put options and you invest, I don't know, 30%, 40% of your account only in selling puts, then when there's going to be a crash, because there will be a crash at some point, we never know when it's going to happen, but there's for sure going to be other crashes happening, then your margin is going to expand. It's probably going to double or triple at least, and you're going to have to sustain this position. Otherwise, you'll have to close it for a loss. Your broker will force you to close it for a loss. And that's what we call a margin call. And so many people get into margin call because I know that it's very tempting to, sell a put because it only requires you to hold like $500 in buying power, and then you can just sell that put. Except that when that put goes in the money, then you're going to need now $1,500 just for that position. And if you've sold 10 puts, just puts, and then the stock market crashes, then your margin required is going to triple. And if you have been investing too much, then, you're going to be in a bad situation. And that's what happened to a lot of people in the crash of 2020, so you really need to be careful about this type of things. I don't know, I just wanted to go on a little rant here because obviously even myself, like sometimes I tell myself like, why do I just keep selling calls? Honestly, like every time I sell calls, not every time, but like quite often when I sell calls, it goes against me and it's a pain, and I have to carry that trade for like 2-3 months until it comes back in my favor. I mean, just selling puts would be so much easier. I would make so much more. However, there's always that little thing in the back of my head that is telling me like, if you don't also have some short exposure, then, you're probably going to overexpose yourself on the long side. And it's very, very easy to fall into this and to overexpose yourself. I mean, you know, it can happen very quickly. And in the end, that's what we call like being delta neutral. And, you know, that's not new. Like a lot of people have been talking about it. And even me on this channel, I've been talking about this concept for quite a while. But, you know, the more I trade, the more I'm wondering like how worth it is actually being delta neutral. And is it actually worth it? Should I continue being delta neutral, or should I just stop and start only selling put options? You know, I'm always trying to question my own beliefs and see if there is not something better to do with my money. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.